You are listening to Keystone's Stock Talk Show, episode 224.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a great show planned for you this week. Fresh from his visit to Mickey's Magical Kingdom, Aaron reviews the Walt Disney Company, symbol DIS, on the New York Stock Exchange after the company's shares touched 9-year lows this past week. Does Disney now offer good value, or are would-be investors catching a falling knife near term? Aaron gives you his take. In our Your Stock Our Take segment, I answer a question on Premium Brands Holding Corporation, symbol PBH on the TSX, a leading producer, marketer, and distributor of branded specialty food products. The listener notes that the stock, which pays a 3% dividend, had a strong move to start this year, up 24%, and he wants to know if we recommend it in its current range. Backed by popular demand, Brennan reviews and revisits Graphene Manufacturing Group, symbol GMG on the TSX Venture. It's an Australian-based company involved in the production of graphene used primarily in paints, coolants, and lubricants targeted to improve energy efficiency and additionally in next-generation battery technology. Brennan reviewed the stock in early 2023 and viewed it as overhyped, and the price was not justified by the underlying fundamentals. It has since dropped 40%, and a listener asks us our take after the company's drop. Last but certainly not least, Brett takes a look at the ever topical Nvidia Corporation, symbol NVDA on the NASDAQ, a pioneer of GPU-based accelerated computing. The company released its fiscal Q2 2024 fiscal results mid last week, which beat expectations. Brett lets you know if this high flyer could continue to fly higher, or should it have its wings clipped. Let's get to the show. We welcome my co-host, Mr. Aaron Dunn, and always the killer bees, Brennan and Brett. How you guys doing?
Doing well.
Good week?
Doing good.
Gotcha.
Yeah.
I was actually just telling the guys that I ended up watching Pulp Fiction because I know you guys are always, making fun of me.
Wow.
Yeah, it's a bit of an inside joke for anybody watching, but Brennan doesn't watch a lot of movies. Guy. So, when you reference something from
pop culture,
iconic movie, Brennan is typically...
That's good.
Left confused.
A Royale with cheese. He knows what that is now, right?
But the Royale with cheese. No, Pulp Fiction, that was a classic.
That was a good year for movies, I think. Pulp Fiction was up Best Picture against Forrest Gump, and there was a couple other movies.
That was Travolta's comeback film too, wasn't it?
Without a doubt. He was in obscurity.
He was out doing nothing for a while, and I think it was Pulp Fiction that was his.
Yeah. No, it's good. We're proud of you, Brennan. Keep it up. So when we go into these meetings and when someone references
the entire Marvel superheroes series and movies,
you got 20 movies to watch. It was a good weekend. There's lots of smoke around here, though. A lot of haze coming through, but I think we're getting through it. I think
Ron and I actually saw each other in person,
which was less painful than usual. It was good. It was your daughter's 6th
lots
birthday.
Of other people around. Yeah, my daughter's birthday. Ron's daughter's similar age, so we stood each other's presence for 3-4 hours.
We actually sat next to each other for a lot of it, so it was pretty good. We did pretty good. We just didn't talk about work. There's a lot of kid stuff to talk about, which is good, right? And Disneyland and my trip, so it was good. Yeah.
It kind of was work since I'm going to be covering Disneyland on the podcast today.
It's true. So. We basically worked the whole time at the birthday. So I'm going to speak quickly at the start, just topically on property sector woes. The U.S. housing affordability is really sitting at 4-decade lows. I saw an article on this. I'm going to quote from it. According to Freddie Mac, the average rate on the 30-year fixed mortgage jumped last week to 7.09%. That's the highest in over 21 years. That means essentially a would-be home buyer can afford a lot less home. 3 years ago, $2,500 monthly mortgage combined with a 20% down payment could get you about a $758,000 home. Today, the same monthly payment, 20% down, are only good enough to get you a $443,000 home. Now, with yields on the 10-year Treasury, which is really closely correlated to mortgage rates, kind of hell-bent on rising, affordability is getting worse, and it's risk of getting even worse. The only thing that really can correct this right now, one of the main things that could correct it would be just lower housing prices. And interestingly, and I'll add this on to the end of that article, it wasn't in this article, but kind of a Canadian-centric point here. The housing market has been a bit of a tale of two cities if you look at Toronto versus Alberta, Calgary. Toronto is kind of a tale of woe. From June to July, existing home sales were down 8.8%, almost 9%. So then there's Calgary, where the market was described as hot. Sales over that same period were up 11% year over year. So, and that's mostly, they're saying anecdotally, but I think the evidence is there. It's mostly out of province buyers coming in to, say, the Calgary market because they can't afford the Toronto or Vancouver market. So, kind of a tale of two markets going on in Canada right now. But, the housing affordability is similar obviously within the Canadian market. And there's just so many people that just can't afford to even look at a home there. And moving out of perhaps Toronto or Ontario areas and moving into Alberta where it's been more affordable. So you see a spike there, maybe near term, but you're certainly seeing, again, a tale of two cities there.
Yeah. So I have a question for Brett here, actually, because he's a young man in Calgary. I've heard that because there's such high office vacancy in Calgary, that a lot of the offices are being reconfigured into residential units, and that this is causing kind of like a coolization, or it's making the downtown core of Calgary cool. And
I like that word, coolization. You're like, what did I just say, right?
Well, I realize that could be, construed in many different ways. Well, so
I would say
actually making it, because Calgary has always had a reputation of being, the downtown is really only the business district. And after the offices close, there's not much going on there that, the trendy places to go are in various neighborhoods around Calgary.
We would go into Calgary.
Changing now. So what's happening?
I would say they're really attempting to. Whether it's actually happening is I think
still
a bit
early
more.
Days.
It's still pretty early days. I don't know how much has been actually shifted from office to residential at this point. I know there's always been for the last couple of years, ever since the work from home and remote models have been taking place, there's been a push to that. And there has been a couple like districts, areas downtown, which have switched more to residential. But as a whole, has it been coolized, as Aaron would say? I don't know if we're quite at that point where it's that vibrant youth downtown. I don't think we're at that point like Vancouver or Toronto where you actually have that nightlife. We're not there. We're still business oriented.
Yeah, that is one thing.
I'm sure there's a better word that could be used to describe it. Maybe
I thought it was perfect.
Somebody who actually is cool. Tell me what the word is.
Well, we would always say that though, like coming into Calgary, like we do a conference there like 10, 15, 20, 20 years ago, honestly, we do. And, as opposed to like you'd end the conference in Vancouver or a city like Toronto and, everybody would start filtering downtown and there was like this alive, vibe, the kids say, Brennan, you say these days downtown, right? And in Calgary was so different. Beautiful city. I like Calgary. Like it's a great city but it would like shut down and we'd be there and it was just like, what just happened? Everybody just left. Right. Like, and it was just a totally different vibe, Brennan. in the city. And I guess they're trying, like Aaron said, to bring people downtown, and maybe it'll be successful. But it's going to take a while because
It'd be interesting. I mean, we need
there's urban sprawl all
if
around.
there are
there
vacancies in the
live.
office space, and there's a shortage of residential units, just as a general shortage across the country.
Yeah,
it only makes sense to reconfigure
and so much cheaper to live downtown Calgary than downtown Vancouver or Toronto, right? So,
well, I personally know of several people that moved from Vancouver to Calgary specifically for the reason that they wanted to buy a house.
Yeah.
Right.
Yeah.
They, one of my old friends was a chef that I can remember. He was working in Vancouver. He was doing pretty well, but there's no way he could buy a house. He moved to Calgary, basically same job, probably more money, lower cost of living, and he was able to buy a home. So it makes a lot of sense.
We're now sponsored by the city of Calgary.
I guess
their check is in the mail.
One thing, I was listening to Dave Ramsey's podcast on the weekend, and he actually ended up getting mad at somebody who was saying that he wanted to wait for housing prices to potentially come down because the affordability is so low. And Dave got mad at this individual and was basically saying the best time to buy a house is tomorrow. And he claims, housing prices have only went up except for, after the period after 2008, the financial crash. But I just was like a little taken back. I still think that, what's wrong with continuing to save for, a larger down payment and, being patient with the market. Like affordability is, like you just said, at an how long of a low is it? I just don't see how that doesn't
21 year
some degree. Maybe it doesn't.
Here's my thought. I can understand what Dave Ramsey is saying in terms of if you're trying to time housing prices, right? Because a lot of people, when rates were coming up, would have said, maybe they could have locked in at, 2.5%. And they're like, oh no, rates are coming up. So like property prices are going to come down and there's my opportunity. Obviously that didn't happen, right? But the fact of the matter is that like, it also does come down to affordability, not the national affordability number as much as just the affordability of the individual buying the house, right? I mean, if you're going to stretch yourself so thin that you're going to ruin your life with stress and do nothing but work and still not be able to make your payment if rates go up another, 100 basis points, then maybe it's not the time. But it's also not the time to quit. Then, as you said, Brennan, you need to just continue to save and, maybe invest and do what you need to do when the opportunity presents itself. If, however, you're in a situation where you can afford to do it, then now probably is the best time because you don't know that property prices are going to come down, and trying to time the housing market is like trying to time the stock market. I mean, you might be right, you might be wrong. It's just things don't necessarily happen in that logical progression like you think they are going to. And one thing that I've always said is that when you're looking at time in the housing market, if you are somebody who is looking at it as not an investment but as a place to live for yourself and your family, there are two risks that you need to consider. One is the risk that you could be, if you continue to try and time it and you're wrong, that you could be permanently priced out. The other is the risk that you make the move and prices pull back, but you're still solvent, but you're down on paper a certain amount, right? So what is the greater risk to you? That you could take a short-term loss on something that is really not considered an investment, it's considered a home, or that you're permanently priced out of the market. But then again, there's also the third risk is that you could stretch yourself way too thin to try and buy at a very high price and then put yourself in a bad position where, not only are you out of a house, you're out of your nest egg as well. So,
yeah. And like, that's one principle that like he does talk about lots, and I think that we would all agree with it, where you don't want to drown in your mortgage, have it as about 25% of, your take home after tax income, is what a mortgage payment should be, to try to, start small and slowly, get a starter home, to start with, rather than just all of a sudden taking on a huge home.
I would say he lives in a soundbite world too. So he has that big comment about it's time to buy now. He's talking to a mass audience. And then on the flip side, he says, you only need to spend this much of your income on
But
housing.
Dave Ramsey
So,
also isn't living in Vancouver, right? Like, I don't know where he lives.
so I
but he
mean, you need to
probably lives
look at
in
the
a place where
market you're in.
housing prices relative to incomes
Yeah,
are completely different,
Totally.
right? So it's,
and
I don't
he
think
has
he
his
needs to
big
get
sound
mad to make
bites.
his point, but
Look at the market that you're in and see if it makes sense for you within that market right now. And I mean, it has to be more nuanced. Everything is just one soundbite you're getting from a guy like that. And we can cut out the part where you said you listened to his podcast if you want. So
just sometimes. And again, it is more just pieces. And yeah, if I went, like you were just saying, if I went with the 25% of my, monthly pay, I'd be in a rough area of Saskatoon, and Saskatoon's no Calgary or Vancouver or Toronto. So
is it really rough?
It's pretty rough.
But you're a tough
It's not
guy.
as bad as Prince Albert, though. It's not as bad as Prince Albert. I'll tell you that much.
Now you've lost
now
our Prince
everybody
Albert
in Prince
market.
Albert.
The demographic has just gone out the window there. How can you say that?
Against Brennan for
we'll
they
cut
all
that
have
out. All right.
podcast.
Okay, you want to get to Walt Disney, the Magical Kingdom?
Yeah, because I was just there, and I could have actually covered.
We can see
Disney
the ears on your head right now; they look great.
That would have been a nice a nice addition to this, but no, I'm not going to have any of the.
Oh, trust me, they'll be there in the real cut.
Right. Okay,
you're like, shut
up. Let's take a look here at Disney. Iconic company, obviously. So, couple of the quick stats. Walt Disney Company is the official name. Symbol is DIS. Trades at about $84 per share, and it's $153 billion market cap. So, first thing I really want to note about Disney. The first thing I'll note about actually just being a recent visitor to the Disney parks is that they have a fantastic ability to separate people from their money. And I can speak to that firsthand. And people are doing that with a smile on their face. So you really have to respect a company that has an iconic brand that everybody is aware of, that is able to do such a fantastic job of making people go broke and happy to do it. But aside from that, when we're just looking at the company from a investment perspective, from a financial analysis perspective, first thing is I like to break a company down and figure out, what do they do in all segments of their business and how do they make money. And one thing I will say about Disney here is that it is a very complex company. So I broke it down into a segmented tree just to kind of like show a few of the segments that exist in Disney. I could actually break it down way further than what I did. But if you take the overall company, Walt Disney, that you could break that down into two large segments. The two main segments are Disney Media and Entertainment Distribution. So this is 63% of revenue for the first 9 months of the year. And then the other key segment is Disney Parks, Experiences, and Products, which is 37% of revenue. So looking at that first segment, Disney Media and Entertainment, that further gets broken down into three other segments, which include linear networks. This is more of their cable business, their cable investments. There's direct to consumer, so this is their streaming services, so Disney Plus, ESPN Plus, Hulu, and then there's content sales and licensing. And then when we go back to the other key segment, Disney Parks, Experiences, and Products, that is further separated down into parks and experiences and consumer products. And I could keep segmenting these as well. It's really like a rabbit hole. It's quite a complicated business and very diversified in terms of the different things that they do. Looking at the share price performance, as much as I respect their ability to come up with ways to separate people from their money, share price performance has not been great. Looking over the last year, it's come down from $112 to about $84 per share. Now, when we look at a long-term chart on Disney, the stock is actually trading right now at a 9-year low. It hit a peak in around 2021, March of 2021, at about $185, and now at $84. It's basically seen almost nothing but a dive from that peak. So what's happening here? It's at a 9-year low. Does that mean that it offers tremendous value? We got to get in right now. What is causing this massive share price volatility? So There's a lot of speculation and opinions out there in the market. Some people think that because there's some political baggage with Disney, if you follow, there's an ongoing battle war, so to speak, between Disney and the governor's office, DeSantis's office in Florida. They're trading back and forth. Some people think it's gone too woke, and that's why the share price has not done well. But there's a few different things here. So I'm going to say that I don't think that the political issues really have much to do with this. I think that a lot of it really just boils down to the company fundamentals. And then as well, a few other things that drove the share price to a range in 2021 that it never really should have achieved in the first place. So when we look at the company's all-time high of about $185, we have to keep in mind that this was during the peak of the pandemic craze. So there were some absolutely wild valuations at that point in time. And I think that the main thing that was driving Disney's stock price at the time, well, there was actually two things. One, we were opening up from the pandemic, which meant the parks were opening back up, the cruise lines were opening back up. So people were expecting, obviously a lot of financial improvement there. But then there was also Disney Plus as well. So Disney's streaming service and how it was competing with Netflix. Streaming was a huge tension on the streaming company business during the pandemic. I mean, it still is, obviously, but during the pandemic, there's a lot of tensions. And if you look at Netflix's stock price, it really actually demonstrated the same behavior as Disney's. Right around that time, March of 2021, it had hit an absolutely insane high. And then it subsequently just basically fell off. Now, it fell much lower on a percentage basis than Disney, and has since recovered. Different businesses, but I think that a lot of what people were looking at the time was Disney Plus, and how it was gaining market share relative to Netflix. And this was really adding to the valuation. Since that period of time, that pandemic craze, valuations across the market, in some cases, while still high, have really returned to more reasonable levels. And I think that a lot of what we've seen in terms of the share price decline from Disney is more related to that. It never really should have gotten up to that price. There is nothing justifying a price, in my opinion, of $185 per share. But let's take a look at the recent financial results from the company. For the quarter, their fiscal Q3, revenues were up 4%. Operating income was about flat, and adjusted EPS was down 6%. For the 9-month period, revenues were up 8%, operating income down 6%, and adjusted EPS was down 9%. So really, we're not seeing anything very spectacular in the financial performance from Disney right now. There's some areas of the business that are performing better than others. When we go look back at the Disney Plus business, I mean, I'm a Disney Plus subscriber, so that's another way they're able to separate me from my money. I think it's a very good service. I 100% have plans to continue it, but it is not a profitable part of the business. It was expected to lose money for about 5 years. And I think now we're getting at a point where over the next 1 to 2 years, they're focused on generating profitability from Disney Plus. So that could be a major driver, a positive driver for the company in the future, but it hasn't happened yet. So let's wait to see signs that it's actually going to happen before we get too excited. We'll take a look here at the company's balance sheet. They have about $36 billion in net debt. So relative to their equity, that's a pretty good debt to equity ratio. Relative to their EBITDA, net debt to EBITDA of 3.6 times. For a company like Disney, it's a very capital intensive business. They have cruise lines, they have the parks, they have studios, filming studios. It's not what I would consider to be an unacceptably high leverage ratio by any means, but it's certainly not low. I mean, I would not want to see it much higher than what it is. So I would at the very least say that Disney is a fully leveraged company at this point in time. In terms of what analysts are expecting going forward from the company, so for the current year, analysts are expecting a very moderate amount of growth. The consensus estimate is about $3.72 in earnings per share, and that would put the valuation at about 23 times earnings. So certainly, given the share price performance, or the financial performance rather, that we've seen, the balance sheet, 23 times is not not what I would consider necessarily incredibly overvalued, but it's also not what I would consider necessarily very attractive. Now, analysts are expecting big growth in earnings per share in 2024. The consensus is 492. This would drop the price to earnings ratio down to about 17 times. So much more attractive valuation. And then there's that expected growth in 2024. But I would just say, let's wait and see. I think that analysts have made, if memory serves, some assessments of Disney that have not come true. Expectations have been pushed forward. So rather than just look at that 2024 figure, I would, and assume that it's actually going to be achieved. I would look at it with some skepticism at this point in time. If they are able to achieve that, and most other factors with the market are, reasonably healthy, then I think that the company is set up for good share price appreciation. But I would also be very hesitant to just accept it. One thing that I would definitely say with Disney is if you look at the trailing earnings per share. So I'm just going to look at this from a GAAP basis, not adjusted earnings, but just GAAP earnings per share. There's not really been certainly a consistent uptrend in earnings over time. And in fact, earnings really peaked in the pre-pandemic era, and they have not fully recovered since. Now, again, these are not adjusted earnings. If we were to look at adjusted earnings, it's probably about $3-4 in 2023. So certainly the picture looks better, but we're not getting a consistent growth in profitability per share, which is what we really like to see from a company. So certainly there's some good reasons to understand why the stock right now would be trading at a multi-year low. And just to sum this up, I really like Disney. I like it as a company, being a customer. As a stock, I think that it does have some potential being an iconic brand. That it does have sticky revenue. The valuation is okay, and there should be a good long-term growth opportunity, which includes the potential for profit additions from Disney Plus. But the earnings performance really has been lackluster. The balance sheet leverage it's okay, but it's fully levered company. It's not low leverage. And as well, I mean, this is a high ticket consumer cyclical company. So it is by no means insulated from a recession. Long term, I think that this branding, the iconic brand, is going to be a great asset, continue to be a great asset that produces substantial cash flow. But if we do enter into recession, the company can experience some challenges. So I don't see a reason that I would recommend this as a stock investment in the near term. What I'd be looking for is a clear improvement in profitability. And I do think that there is a long-term investment potentially into the brand. So if people were interested in Disney and they wanted to take a very small position at this point in time, I wouldn't argue with them. But it also wouldn't surprise me if we saw more downside on the stock. And I'm certainly just not seeing a clear investment thesis on why somebody would want to rush into the stock right now, or why it offers fantastic value. So we continue to be on the sidelines with Disney, and we'll just see what happens over the next couple of quarters.
Yeah, it's interesting with Disney too. Part of them now, it is a different environment now, but if you look at their box office releases, the movies they've released over this year, certainly haven't done as well as what you've seen historically. Like if you look at releases this year: Guardians of the Galaxy, The Little Mermaid, Ant-Man and Wasp, Indiana Jones. Just for comparison purposes, if you look at like their highest grossing movie this year, Guardians of the Galaxy Volume 3 is about 844 million worldwide. Sounds like a big number, but if you go back to 2019, Avengers Endgame did 2.78 billion. Star Wars Force Awakens did 2 billion. Like Avengers Infinity Wars did 2 billion. So like really on the list right now, it's number 35 of the movies they've released. So you're seeing you're not seeing comparable numbers at the box office for some of these movies. They're not hitting it out of the park. So you're not seeing some of the windfall profits you can get from those movies if they really hit. Now, it is a different scenario now. Back in 2019, they didn't really have Disney Plus. So people are now, instead of going out and watching it at the box office or watching it at your theater, you can grab the movie a couple months later, a month later, or you can even wait and get it streaming several months later as part of your package. So I am sure some of the audience is just saying, let's take a pause. We'll watch the movie in 3 months, and you're not watching it at the movie theater. But still, when you look at those numbers, you can see it is a significant decline. They haven't hit it out of the park with any movies in terms of box office receipts over the past several years. Certainly not in 2023.
Another interesting thing that recently they did, or Disney's ESPN ended up striking a deal with Penn Entertainment, I believe, where they're actually planning on launching a sports betting, or jointly launching a sports betting business together. And from my understanding, so under the terms, Penn will pay ESPN about $1.5 billion in cash and offer about $500 million worth of warrants to purchase its shares, blah, 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 blah. Either way, it's interesting just to see, the company is partnering with Penn to essentially, launch a sports betting app, which is becoming
sports and gaming are just interlinked now. Like it's become,
they sure are.
It's crazy how it's become.
And of course that was so topical because Penn ended up, cutting its ties with Barstool Sports, and basically just giving the business back to Dave Portnoy, who I'm sure many of our listeners have heard about. And decided to go with ESPN, which is probably the better route.
It's certainly a bigger brand, more sport, and a different audience is watching all across ESPN than is watching just Portnoy's boys.
Exactly.
Portnoy's boys. Barstool.
Exactly.
Yeah. Anyways, interesting for sure. And those like sports and betting is just intertwined right now. I know my dad, every time he watches sports, he curses it down. What is this gambling every time I have to see? But like, there's so many people that, it adds juice to the game. That's, I want
my friends, man. It's crazy. It's
lunatics,
like,
right?
It drives me nuts. It's like, if you spent any bit of time building a portfolio, rather than speculating on sports,
fantasy leagues and gambling. It's true. All right, let's move on. Premium Brands Holdings Corporation, PBH on the TSX, trades around $104.35, $4.65 billion market cap. What does the company do? They're focused on acquiring and building value-added food businesses and brands that benefit from being part of their ecosystem, essentially. The platforms and brands are active in the Canadian and U.S. retail and club for food services channels. Let's look at the company's second quarter results. Record revenues in the quarter, but just up 7.3% to $1.63 billion compared to the second quarter of 2022. Record second quarter EBITDA, adjusted EBITDA was up 16.5% to $152.4 million. But adjusted EBITDA, the margin was up to about 9.3% from 8.6% in the second quarter of the previous year. Second quarter adjusted EPS, however, was down 8% to $1.27 in the period. Want to look at valuations. Trailing EV to EBITDA is in the range of 15.89. Based on its current year's expected adjusted EBITDA, the company trades with a forward-looking EV to EBITDA in the range of 12. Premium Brands has significant leverage with net debt of approximately $2 billion. To put this in perspective, the market cap, like we said, $4.6 billion, and its estimated adjusted EBITDA for the current year is just under $600 million. So on a trailing basis, net debt to EBITDA is in the range of 5.6 or 4.55 on a forward-looking basis. Both are high in terms of leverage ratios for this company. There are those that will adjust out the company's convertible debt and arrive at a figure of roughly 3.6, but the convertible debt is debt, so we're going to keep it in there. Our take, Premium Brands has been a solid Canadian food services consolidator, but as it has acquired more and more businesses, debt has mounted, and in a higher interest rate environment, capital is now more expensive. The cost of carrying that debt is squeezing profitability and will squeeze profitability. Additionally, the company's ability to continue to acquire, to grow, which has been part of its lifeblood, has been impeded. Now, we have liked the business in the past, but the revenue growth rate continues to be slow and slowing, coming in at just 7.3% in the last quarter. And on an adjusted basis, earnings were lower in the period. Valuations are okay, but with a lack of growth or high-level growth, even mid-level growth, the share rebound year to date has the company trading closer to fair value than undervalued at present when I look at it. And that's all
we
I got.
looked at the company last year. I wrote a report up to Q3 2022, and I noted in that report that they were exceeding their targeted debt they targeted at the time. And I'm guessing this is still the case of 3.5 to 4 times adjusted EBITDA.
Yeah, basically.
So they're still well above it. And so if they're constantly exceeding their target, what good is that target when you're looking at it as a company? Really, it's just they're over leveraged at this time compared to what they want. So what we want as well.
It's a couple evils that are hitting them there. I mean, they obviously interest rates go higher. It's, the more debt they have, even if they have this consistent debt level, if you were paying 4%, now you're paying 8%. I mean, it hasn't been a jump like that, but if you have that type of jump, you're squeezing your profitability. And then they've always been able to have access to relatively, easy capital via debt. It's not as easy to get. It's more expensive. And, if you want to go out now when they may think their share price is undervalued based on EBITDA, for example, you're going to be more dilutive at that point. So it's a catch-22 situation they're in. Everything's great in a low rate environment. Now you're kind of paying the piper for the debt you built up over that time. I think there's some great brands in the company. It's not a horrible business by any means, but will they be able to grow at a rate that'll get them anything close to a premium valuation on premium brands? I don't think so at this point.
Yeah, and I just looked like all of their debt's basically variable. So yeah, I just quickly looked.
Mm-hmm. It's squeezing profitability and will continue to. And, they have high input costs. Now, some of the food prices have come down over the course of this year. That could help improve margins. It's something to definitely look at. But, interest costs have not gone down. So they're going up significantly, and debt is high. And, they have convertible debt too. Maybe it doesn't get converted, but, it is debt that's sitting there. So we're going to factor that into the equation too. And when you do that, they're, the debt levels are high, relatively speaking. All right. I think that's it we have for premium brands today. Let's move on. I think Brennan is going to revisit graphene manufacturing. Is that correct?
That is correct. So yeah, we've been getting...
Is this an I told you so?
Not completely and I told you so, but I was getting ripped apart on the internet, and it's like I'll get into it in my conclusion. So yes, we've been getting a lot of questions on Graphene Manufacturing Group, so I thought that I would update the stock since I last covered it in early 2023 when the stock was trading at about $2.30, and now the stock is down around 40% since I covered it last on the podcast, to where it's now trading at about $1.34 per share and has a market cap of about 112 million. And just for reference, they are GMG on the TSX Venture Exchange. So the company is an Australian-based company involved in the production of graphene used primarily in paints, coolants, and lubricants, targeting to improve energy efficiency and additionally also in next generation battery technology. So here, they do have two segments essentially. So in the energy savings segment, they're focused on their Thermal XR, which is a graphene enhanced HVAC-R coating or energy saving paint essentially. They also have their G lubricant, which is a graphene enhanced lubricant additive that seeks to reduce fuel consumption and carbon emissions. And also their G coolant, which seeks to improve the thermal efficiency of engines. Now, in their other segment, they also have their energy storage segment, where GMG and the University of Queensland in Australia are working collaboratively with financial support from the Australian government, and now, as of recently in May, Rio Tinto, to progress further research and development and commercialization of graphene aluminum ion batteries, including a coin cell and a pouch cell battery. So some operational updates here. On August 28th, the company provided an update to its commercialization progress of Thermal XR, having commissioned its graphene enhanced coating blending plant with expected capacity to produce up to 500,000 liters of Thermal XR restore coating per annum. But of course, this is subject to their graphene production. On August 17th, the company announced the closing of a $3.45 million equity offering, issuing a total of about 2 million shares at a price of $1.70. And each share comes with a half warrant with an exercise price of about $2.20. And I believe that after this offering, the company has about 84 million shares outstanding, along with 4.3 million options and about 5 million warrants. Now, on May 29th, they announced a battery update indicating that it became clear to them that pouch cell rather than coin cell batteries were of greatest interest to potential key customers. So GMG is currently making single layer pouch cells to proceed to a 5-layer pouch cell testing. And then they continue to expect to increase this up to about 25-layer pouch cell prototype, which they expect to have by the first half of 2024. And on May 18th, they announced a joint development agreement with Rio Tinto on its battery technology. So this is good news, where Rio Tinto will contribute technical and operational performance criteria and 6 million Australian dollars in exchange for preferential access rights to the battery technology. And it is expected to last about 2 years, with payments spread over the term of the agreement. And it aims to essentially co-develop this battery together and to kind of make a proof of concept. And they even say that, a proof of concept, in the news release. So moving forward, the company continues to be focused on 4 objectives: to produce graphene and improve the scale and the production process, also build revenue from their energy-saving products, and then, of course, develop their next generation battery. And then last, develop supply chain partners and project execution capability. And I just wanted to quickly show this for visual representation for those watching on YouTube. It's just a slide directly from their investor presentation showing their path forward and where they are at their battery technology. So, they still have a lot of room to go, essentially. And looking at the financials, they're pretty dismal here. So for Q3 of 2023, these are all in Australian dollars. Revenue was essentially nil in the quarter, while adjusted EPS was a loss of $5.04 per share compared to a loss of $2.45 per share for Q3 of 2022. And the balance sheet had about 8.8 million with no debt, but this does not include the most recent equity raise of 3.45 million Canadian that they conducted. So to conclude, as I conclude here, I wanted to pull up on the screen a few comments which ripped into me for my low quality research, telling me to do some real work next time. Well, first off, this is a free podcast that we do weekly, and I'm not going to spend hours upon hours researching companies which are speculative, produce essentially no revenue, continue to lose gobs of money, and continue to issue shares to keep the lights on. I spend my time researching quality companies for our clients who pay us to find them quality businesses, opposed to what GMG is. It's simply a concept stock. Now, I have no idea whether the business will ever be able to make money. So as it stands, the business is a concept. Now, yes, it is working to sell its thermal XR products at scale, but even when it does start generating meaningful revenue, we still do not know if it will make money or not. And second off, yes, it is quite positive that they're working in unison with the University of Queensland and Rio Tinto to develop their battery. But no, I did not waste my time to call Rio Tinto or the University of Queensland, like one of these comments suggests, for them to explain to me what prototypes they're working to develop. Again, as I said last time, there is speculative potential, but the business is still a concept and far from meeting our investment criteria. And to me, it's not a surprise that the stock is down 40% in 7 months while it remains a concept and they continue to dilute. Now, if they can commercialize their battery and begin to ramp up their thermal coatings and lubricants, yes, there is a case to be made that the stock has upside potential, but this is a huge bet on management and an unknown, and essentially technology which I do not claim to understand. Now, like this last comment from blue_beep hang glider, who says, I will put money into this because of this potential bonanza, but only what I can afford to lose with a shrug. Now, I see no problem taking a speculative bet with a teeny tiny portion of your overall portfolio, which you are willing to lose. But as we say time and time again, if you build a 15 to 25 stock portfolio comprised of stocks like GMG, over the long run, you're bound to do poorly. I'll open up to you
Didn't
guys.
you ask yourself why they were able to fundraise very easily?
Mm-hmm. Which was another comment, right? Which
Maybe
was
because there's a lot of investors that understand the technology that are willing to give them whatever money they want.
No, exactly. And I just,
Like
the first guy
the whole idea able to fundraise very easily from retail investors by selling a story. Like we don't invest in stories, we invest in businesses that are producing products and services and able to sell them to the industry that they're servicing, right?
Yeah.
So yeah, go call the University of Queensland and Rio Tinto. I'm sure when you call the person who invented it, they will say all pleasant things about the product. But when you ask them, well, why is it not generating any revenue or income? Well, they have a good answer for that.
Yeah.
No, exactly. And it's just, on the, they're able to fundraise very easily. Well, it's just like any junior mining stock. All of a sudden they get a new CEO in and they start touting, oh, this CEO has, raised this amount of money in capital markets. Who cares? He's just diluting, again, it has potential, but it's just so spec. GMG here.
Well, I would say the potential is unclear. It might be a nice sounding story, but I would still even just say the potential is very unclear.
Exactly.
Yeah, anyway. And I think one of the biggest bonanza opportunities, as what was said in the comment there, is the battery tech, and they're a small, tiny little player. There is much bigger companies that are trying to produce new battery solutions with the electrification. We covered quite a few of those. Mm-hmm. We were looking at them in our electrification report. There's much bigger players. There's much bigger funding. So if there is a solution, you're betting on a small player. You're betting on that lottery ticket, not a big player. Like it's very unlikely that a tiny player is going to beat out a large company when it comes to research and development, because you're putting exponential more money in from those large companies versus a small player raising that $3 million at a time.
Brett, come on. Did you even call the University of Queensland?
Come on, Brett. Just would you get on the phone?
I don't understand the
University of Queensland.
When I saw that comment, it's like, come on, man. Like, how much spec can you, or how much due diligence can you put into like a spec business like this?
Well, the point is, we don't see a lot of value in doing that, and we see value in buying businesses that have existing profitability, revenue, and growth there, and building a portfolio of 15 to 25 companies that have that type of profile, versus if you added 3 or 4 of these concepts, or 15 or 20 of these in a portfolio that are just concept. These are concept stocks until they produce any revenue or any profitability. Make no mistake, until people have paid for these products or services, they're concept stocks. And we've seen for 25 years, if you build a portfolio that's centered around businesses like this, you will do poorly over the long term. If you build a portfolio that has companies with good valuations, good growth ahead of them, and sound fundamentals, then you have a fighting chance to beat the market over the long term, and significantly beat the market. And that's what we're trying to do. And that's what we try to look at and teach to our clients, show to our clients when we issue them research, or just talk about on this podcast on a weekly basis. And that's the concept we're trying to get across. You can fall in love with the technology. It's the quickest way to be to be taken from your money, essentially. Mm-hmm. And that's what we see on a weekly basis. And it really makes me kind of sad to see people, get behind and what they think they know about a technology in a small company and marry themselves to that stock. It's not something that is good fundamental investing over the long term. In this case, maybe this company has the secret sauce within its technology to produce a winner over the long term. We're saying that we cannot analyze that. We can analyze the fundamentals of the business. What we did at the start of the year, we looked at a ton of electrification type businesses. we recommended a company called Hammond Power. It was trading at $19.90 at the start of this year. It traded at 8 times earnings, had tremendous growth. Today it trades at $54. Well, that was a company with growth, revenues, earnings, net cash position, benefiting from the electrification boom like you're trying to do with this graphene company. But it had all of those things that check off our boxes. And you can see the stock's up 150, 170% over the course of this year, 170% in that range. That's what we look at. Those are the type of businesses that we like our clients to invest in, because you're investing. There's always speculation investing, but that's pure speculation with a concept stock. This has some fundamentals behind it, and that's why we look at those type of businesses. Position your portfolio with 15 or 25 companies that have the profile of Hammond Power, not a concept stock. And this is not banging on graphene manufacturing. It's just that type of business versus the fundamental value-based business that you can see in, say, a Hammond Power. And those are the type of returns that everybody's looking for, like 170% in a 7-month period. That's what you're looking for when you're trying to tremendously beat the market over the long term. Look at those type of businesses, structure your portfolio with 15 to 25 that have that profile, not a concept stock. So that's my soapbox. I think Brandon,
thanks for backing me up, eh?
Yeah.
We'll see what people have to comment.
Brandon. Oh, I'm sure they'll say, you don't know anything about the technology. We're really not even talking about that. We're talking about the philosophy behind our investing, exactly. The concept of the way we invest in companies and why we do it that way and how we justify, our purchases of individual companies and our recommendations. All right, let's move on. The show's going long. Nvidia Corp. Brett's got that one.
Yeah, another one which I'll probably be told I don't understand the technology. So here we go. Nvidia, symbol NVDA on the NASDAQ. It really needs no introduction, but I'm going to give you one anyways, just in case you're not familiar. Nvidia is a pioneer of GPU accelerated computing, specializing in products and platforms for large growing markets of gaming, professional visualization, data center, and automotive. The stock is up over 220% year to date, currently trading at roughly $460 and a market cap about $1.14 trillion, making it the 5th largest public traded company by size at this time. The company released its Q2 2024 results mid last week, which have beat effectively all expectations of the company's already high revenue growth. The company had a record quarterly revenue growth of $13.5 billion, beating the previous guidance, that is, of $11 billion, up 88% quarter over quarter and 101% year over year. Clearly, that's just a massive improvement for a company this size. The growth was as a result of both pricing increases as well as units sold, notably of its HGX system, which is the platform built for AI use. Notably, we saw as well higher gross margin of 70.1% compared to 64.6% in the last quarter and 43.5% in Q2 of last year. GAAP EPS was up to $2.48, up from 26% last year, while non-GAAP EPS was $2.70 versus 51% in the prior year. Again, massive increase fundamentally for the financials. The largest non-GAAP adjustment as well was share compensation, like many other companies. Materially, all of the increase in revenue and ultimately all of the income increase was from data center due to the AI gold rush. Revenue from data centers increased to $10.3 billion, up 141% from the last year's quarter, from the last quarter, and from last year it increased 171%. Whereas gaming, the second biggest segment, rose only 22% year over year to $2.5 billion. Just to give an idea of the revenue split previously for fiscal 2023, so last year, effectively just calendar 2022, 56.6% was from data center, 34.2% from gaming, with the remainder from visualization and automotive. Now, the last quarter, data center revenue was 76.8% of revenue, with gaming only being 18.5%. I want to make that clear. Effectively, all the growth really has been from data center, which is largely AI-driven. The headlines of Nvidia really being an AI-driven company is completely true. It is tangible, and it is trackable to see that it is entwined with AI at this time. Further, the company once again released strong guidance for Q3. Revenue is expected to be $16 billion, plus or minus 2%. This is the same percentage range they gave last quarter, which ended up being significantly surpassed. So just a grain of salt, even though it was to the upside. Last quarter, management guidance really can materially differ from what they expect, even in a couple months. Non-GAAP gross margin expected to be 72.5%, plus or minus 50 basis points, with non-GAAP operating expenses being about $2 billion and other income expected to be $100 million, resulting in a midpoint non-GAAP net income under management guidance of about $8.3 billion, which would be up 23% quarter over quarter if guidance is correct. That is a big if, of course. As we saw last quarter, it could be substantially higher, and of course, on the other side, it could be substantially lower. At this time, I think they need to increase their 2% range, to say the least. So moving on to valuation, the company is trading at a trailing non-GAAP P of 88 times with a trailing price to sales of 35 times. Quite expensive valuation looking back, but of course, the company has shifted nearly all of its growth to data center AI from a mix primarily of consumer graphic and data center. However, going forward, using just analyst expectations, it is trading at roughly 48 times non-GAAP earnings and 21 times sale. If these forward valuations come true, the company still isn't exactly cheap, but it is becoming more reasonable. Not cheap, reasonable. I want to make that very clear. However, I do really want to go through a few risks because the valuation is based on large growth expectations. So really, what could derail this Nvidia AI story? First off, the company has a near monopoly on data center GPUs at this time, especially for large language models or LLM AI tasks like ChatGPT. However, AMD, the main competitor to Nvidia, is expecting to release its ML3 or MI300 chip later this year. I would expect to mean like a big market shift, switch to AMD like we saw AMD and Intel a few years ago with compute chips or CPUs. But it would not be surprising to see Nvidia's pricing power be lowered because of this, because you have to offset, hey, we can buy two Nvidia chip or two AMD chips to offset one Nvidia chip. Should we make that change? Is it worthwhile for a company who's buying potentially thousands of these units to make that change? And as well, you have to look at power and price to performance, because they are using a ton of power when you're powering thousands of these chips. That is always a concern for these large data centers. So while as well, Nvidia did say that both pricing and unit growth were part of their growth recently, they did not break out how much was pricing growth, but we can see how much their margins increased for gross margins. We saw it go from about 50% historically to now this 70%. If that does come back down just due to competition, obviously that's a massive risk. The second risk is demand does not only continue to stay high, but it needs to also stay high. We've seen previously Nvidia saw growth from Ethereum mining in 2017 and then needed to revise its earnings significantly lower once that fell apart. While AI is by no means cryptocurrency, it clearly has more legs to it and is supported by larger players and a more tangible market. If the end market changes its needs, Nvidia's growth would severely suffer. In this case, something similar could occur if AI's end products pretty much just stop seeing growth. We saw a big, massive growth with ChatGPT. It just set a new wave of growth expectations, new wave of products over the last year. But if it's another 5-10 years before we see that another really step up in products, you might not see that recurring investment in data center players. And they need to see that return on investment to keep on making these large billion-dollar investments over and over again, which is where Nvidia comes in. Semiconductor investment is really just cyclical historically, and I cannot see with the advent of AI really changing that cycle. And the current heightened demand could even cause a larger difference between the peak and trough, as we are seeing this significant, really, everyone needs to get into AI at this time. Third, it is a geopolitical risk, specifically in China. In the last quarter, Nvidia had roughly 20% of its revenue from China, which it already has sanctions set against it for Nvidia chips. So it needs to actually sell a cut down version of its AI chips at this time. And obviously, if sanctions were to increase significantly, if it was just, hey, no more significant or I should say powerful AI chips, because right now it's just really a power-based thing, sold to China, that would obviously cause the consumption to drop overnight. And it's out of Nvidia's control. It's really just geopolitical tensions. And of course, it's stated many, many years, and effectively every semiconductor, there is the reliant on TSMC at this time, or Taiwan in general, for their most advanced nodes, which are manufactured there, which of course China has been threatening to invade since the end of the Civil War in 1949. So obviously that's big historic risk. Whether it happens or not, I have no idea. But if it were to happen, it'd be significant downside, so it is worth noting. Concluding, Nvidia has strong operational growth. There's no way to say that it doesn't, but the current tailwinds of AI over the past couple quarters are already really implied in the price. The AI tailwinds need to stay strong, while they need to also overcome the potential headwinds of impending AMD competition, as well as demand risk. If it is just everyone gets in the door, but once that goes away, is there legs behind that as well for that recurrent investment? I would really argue at this time, Nvidia is starting to become a crowded trade with the current valuations, needing to continue at high growth, but potentially having these material risks to demand, creating potentially significant downside if we do not see this recurring investment. At the core, you are investing not just in Nvidia as a company at this time, but really in the success and growth of AI. At the current prices, I wouldn't be invested, but at lower prices, it is definitely appealing as a company.
On that note, I mean, it's like you said, like it's appealing as a company. You know, a Peter Lynch quote: "Wonderful companies become risky investments when people overpay for them." You know, so it's just, I guess that's, you know, essentially what we're seeing here is price to perfection. And, you know, as all of a sudden you're demanding, you know, 50 times forward earnings, you know, it's up there.
GPUs are essential infrastructure for AI development, as well as cloud and a lot of other things as well. You know, we're already halfway through 2023. So you look 2024, analysts are estimating 15 times earnings non-GAAP, or sorry, $15 in earnings non-GAAP, which puts the valuation about 31 times. I don't think that that's that expensive. Of course, they have to hit that target. And then you also have to consider, like, well, what is the differential between GAAP and non-GAAP in there too? But I mean, I'm not seeing something that's ridiculously overpriced here. I think the main risk is just, as Brett said, you know, it's not so much we know that AI is the future, but it doesn't mean that there's going to be consistent growth year over year in the demand for GPUs, right? Like, we've seen a major step up recently with ChatGPT and GPT-3, and a lot of times you'll see that major step up, and then things kind of flatline a little bit, or they increase at a much more moderate pace for 5 or 6 years before you see like another step up. And we have ultimately, Nvidia is a hardware company primarily, not a software company, although they are getting more into software in the future, but they're primarily a hardware company. So it's not a recurring revenue business. We have seen volatility and cyclicality in the company's financial performance in the past. So those are things to consider.
That would be my take on the valuation. In terms of just hardware versus software, it's typically harder to maintain a margin over the long term in hardware, and there's less recurring nature, obviously, to it. It's often not non-recurring. So does it deserve a high premium valuation that, like, a software giant, say like Microsoft or an Adobe or these companies that have a SaaS-based business that is very recurring, higher margin, less volatility? So it's trading right now at valuations that kind of rival those names. Does it deserve to be at those multiples? Maybe in the near term, where you see, you know, a ton of activity around AI, and perhaps that continues, but they don't have the recurring nature, and they don't have the margin profile that's sustainable. To me, most hardware companies don't have that. And so does it, you know, you can see this extreme volatility in the share price over the last like 4 or 5 years. So that would indicate that it probably continues that way, because you have cycles in companies like this, and it's hard to pay a massive premium for a business that is, you know, that has that cycle to it, for me.
And just on the hardware pricing, you can see just with the gross margin, like they are definitely trading at or selling at a quite high margin right now. due to the lack of competition. That's why even though I don't think AMD is going to take a large share of the market, because they haven't historically for traditional compute tasks, if they do even start to just get that 10-20% margin or a market share like they have before, that 70%, if it goes back down to 50, there goes your growth for a couple quarters, even at these high rates.
Yeah. No, it's interesting. Something definitely to watch. All right, that's going to conclude our show for this week. Keep your questions coming in for our Your Stock, Our Take. We'll endeavor to answer those each week. If you're watching this on YouTube, smash that subscribe button, and we'll continue to put out this content. If you're listening to this on iTunes, rate and review us on there. We'd love to hear what you're thinking, and only 5 stars is what we look for on there. Thank you very much. Again, I'd like to thank everybody for listening. As always, wish you profitable investing.
Okay, thank you.
Thanks, everyone.
Thank you.